Welcome, portfolio managers and advisors, to this explainer masterclass on institutional market behavior. I've spent decades tracking institutional flow, and today we are going straight under the hood of the commitments of traders, or COT data. We're going to build a professional-grade analytical framework for the gold market. Okay, let's dive right into this syllabus. We're going to progress from the physics of market mechanics all the way to building your own automated tracking system. We'll cover the hidden mechanics of margin cascades, currency flows, and vault risks, institutional versus retail sentiment, the anatomy of a market correction, and finally, building your automated daily dashboard. I want to kick things off with this absolute core philosophy from our May 2026 source document by commodities analyst Carlos. Narratives do not lead positioning. Positioning leads narratives. As professionals, we aren't here to trade financial media headlines. We leave that to the amateurs, right? We are here to track actual institutional money. Because if you read the positioning data correctly, you know the true story before the ink on the headline is even dry. Let's start with Section 1, the hidden mechanics of margin cascades. Before we even think about analyzing sentiment, we have to master the pure physics and structural risks of the trade. And this brilliantly illustrates exactly how leverage transforms a simple, gradual decline into a violent liquidity cascade. Imagine a hedge fund sitting on a massive, fully leveraged long position with, say, $120 million in margin. Well, all it takes is a measly 3% drop in the price of gold to completely obliterate that equity. Suddenly, step 3 hits. The broker issues a massive overnight margin call. The fund simply can't pay it. So the broker forcefully liquidates those contracts into the open market, which triggers step 5, a self-reinforcing price crash. You see, the COT report tells us who is in the water, but leverage tells us who is about to drown. We also have to consider structural risk in the physical vault. Think about this number, 4.6. That is our coverage ratio, meaning for every single ounce of physical, deliverable metal actually sitting in the COMEX vaults, there are 4.6 ounces of paper promises floating around out there. Now, while most contracts do settle in cash, if even a fraction of those massive institutional longs suddenly decide to stand for physical delivery, that 4.6 ratio becomes a massive systemic powder keg for a delivery squeeze. The shape of the futures curve also dictates long-term profitability and reveals hidden underlying stress. In a normal contango market, you are essentially bleeding capital every single month just to roll your long contracts forward. You literally need the price of gold to rise just to break even. But in rare backwardation markets, speculators are actually getting paid a positive roll yield to wait out physical shortages. Knowing this distinction tells you if those massive institutional longs are acting confidently or if they're desperately bleeding cash while they wait. Moving right along to Section 2, currency flows and vault risks. Let's shift our focus to the macro puppet strings that manipulate gold positioning from the outside. We can easily classify trader intent by checking the dollar index COT right alongside gold. If speculators are short the dollar and long gold, well, that's a structurally sound, coherent macro bet. But if they are long the dollar and long gold, that is incoherent momentum chasing. They are just blindly following momentum in both markets without a real thesis. It's a highly fragile setup that is pretty much doomed for intense fundamental pressure very soon. And we definitely can't forget the ultimate funding trapdoor, the Japanese yen. Global speculators love to borrow cheap yen to fund their massive gold longs. But if the Bank of Japan shifts policy and the yen suddenly rallies, that carry trade violently unwinds. Speculators are forced to immediately sell off their gold just to cover those yen loans. As an advisor, you absolutely must watch yen fluctuations to spot this hidden risk to your gold allocations. All right, Section 3, institutional versus retail sentiment. This is where we explore the dual-track dynamic of the market and how professional smart money essentially sets the trap for the retail public. Here is the fundamental divide when we map decision-making profiles. On one side, you have institutional hedgers. These are professional speculators using COMEX futures to anticipate moves, dealing with high barriers to entry like $250,000 per contract. Meanwhile, retail speculative flows using tools like the GLD ETF have zero barrier to entry. The public is entirely reactionary, almost always buying right after gold has already rallied, usually just in time to catch the absolute top. Let's do a quick practice exercise to test our joint indicator matrix. If the COT data shows managed money, meaning the professionals, reducing their long positions, but at the exact same time, GLD ETF tonnage, representing the public, is surging, what is actually happening in the market? Think about it for a second. So the crucial point is, this is the ultimate danger signal. The professionals are actively selling their positions into the buying pressure of the retail public. The late arriving public is unwittingly providing the exit liquidity for institutional profit-taking. If you don't actively map institutional flow against public reaction, you risk putting your clients in as the greater fool right at a market top. And this whole dynamic is usually fueled by financial media. We call it narrative tracking. By the time mainstream headlines are screaming gold to $3,000, institutional positioning has already maxed out. When your clients call you all excited because of a front-page article, the smart money trade is completely over. The media narrative isn't news at that point. It's really just an unpaid advertisement designed to attract retail bag holders.
Which brings us to Section 4, Anatomy of a Market Correction. Now we're going to do a forensic case study and put all this theory into practice with real data. The famous Wall Street cheat sheet psychology cycle maps flawlessly onto cold, hard COT data. Human greed and fear literally show up in the math. The euphoria stage perfectly aligns with an extreme, managed money net long position, like the massive plus 94,000 contracts we saw back in May 2026. Euphoria isn't just a fleeting feeling. It is a highly measurable data point that warns us a top is imminent. Let's move to and see how this builds through the 5 phases of a forecasted correction, using our forensic breakdown from May 5th, 2026. At T-4 weeks, we hit that extreme Phase 1 reading. By T-1 week, Phase 2 divergence sets in. Professionals quietly start hedging, while open interest actually falls. Then at T0, Phase 3, a random trigger event, like a hawkish Fed shock, lights the match. For the next month in Phase 4, we endure a violent liquidation cascade with an 8 to 15% crash as margin calls hit. Finally, by week 8, Phase 5, the market resets into extreme pessimism, which creates the mathematically safe entry point for the next cycle. To keep your portfolios safe, I've put together this actionable vulnerability checklist. Before you decide to ride a trend, ask yourself, is average leverage dangerously high? Are long positions crowded with the COT index in the red zone above 80? Is steep contango bleeding out the roll yield? Is the put-call ratio showing extreme complacency? If you check multiple boxes here, you aren't looking at a bull run anymore. You are looking at a powder keg waiting to blow. Finally, Section 5, Building Your Automated Daily Dashboard. Let's translate all these institutional insights into a highly practical, automated data pipeline. Look, manual analysis is tedious and, let's face it, emotional. You need to build a cold, automated tracking pipeline. Step 1. Use a simple script or spreadsheet to pull the raw CFTC data every single week. Step 2. Have it automatically calculate the net positions. Step 3. Convert that data into a visual 156-week rolling COT index. And Step 4, absolutely the most important part, configure email alerts. Let the system tell you when the market hits extreme zone thresholds, completely removing your human emotion from the equation. Once you build this for gold, you can expand it across the board. With a multi-asset dashboard, you can spot cross-asset systemic risk at a single glance. In this mock case study, gold is in the red zone at 82. The S&P 500 is overbought at 85. And the VIX is flashing green at 15, indicating extreme, dangerous complacency. This tells us the entire speculative community is partying at the exact same time, vastly elevating the risk of a cross-asset liquidation cascade. Which brings us to a provocative final thought for you. If your automated dashboard flashed red across gold, equities, and the VIX today, would your portfolio actually survive the ensuing cross-asset liquidation cascade? I highly challenge you to implement this institutional masterclass framework immediately, well before the next margin cascade begins. Thank you so much for joining me for this explainer, and I'll see you next time.